estate tax, plus all the likely changes on the income tax side, mean we've got to start thinking differently. When a donor or a client comes in to talk to us and they've been reading about, how many of you have websites that talk about gift annuities and trusts and all the fancy stuff? Most people do. So today what is happening is our donors and our clients are going and reading that information on their own, learning a lot about it, and then coming to someone, coming to their advisor, coming to a charitable organization saying, I've been reading about such and such and now I want to talk about it. I'm interested in that gift annuity. I'm interested in that flip unitrust. I'm interested in doing something more sophisticated or complicated. And what happens as gift planners is almost on autopilot. You begin to think when somebody says life income, right? They want to make a charitable gift, they want life income. We immediately, I think, on autopilot start going through, okay, gift annuity, the charitable trust, maybe we've got a pooled income fund that we could plug them into. And we begin to think about, will that work? And let me give you a real life example. So a year ago, a gentleman called from California. So I work at the University of Texas at Austin. I just finished my 7th year. And we're in a $3 billion campaign, as Hallie knows well. And Hallie, we're less than $200 million away. We almost got it done. Isn't that astounding? Less than $200 million away. So a gentleman calls in from California, and he's been in California his whole life. His mother graduated from the University of Texas. He's not sure what year, but he knew what sorority she was in. She was a Pi Phi. He thinks late 20s, early 30s, his mother graduated. And so he also inherited mineral interests that the family had owned in Texas for many generations. And in Texas, if you have the good fortune of inheriting mineral interests, and of course now we've got them all across the country, thanks to fracking and all of that, you've never let go of those. You've learned almost from the cradle that you never give away your mineral interests. So he's got mineral interests in the Permian Basin, which is Midland, Odessa, that area out there, where they're recovering a lot of additional oil than they had in previous years, or re-drilling and doing some changing how oil is produced. And so what he wants is he wants to continue to benefit from the mineral interest for the rest of his lifetime. He's mid-70s, and for his wife's lifetime, she's late 60s. And then they've got 3 or 4 kids, the youngest of whom is 25. So that's what he'd like to do. He'd like to continue that. And then when the youngest child, or when the last child passes away, then he wants those mineral interests to come to the University of Texas and wants us to own those and manage those to support medical research. So as a gift planner, what am I thinking? If I came to you with that scenario, and it's life income, eventual remainder to the University of Texas, what are some of the things you might think in that scenario? Anybody want to volunteer some of your mental evaluation, what you'd be going through? Anybody want to be brave? Well, okay, I'll give you the answer. You'd start thinking, okay, would a gift annuity work? How many of your organizations would do a gift annuity that has a child who's 25 years old? No. So your policies probably say that ain't going to work. Okay. Then when you think about a charitable remainder trust, what do we have an issue there? Can we do a charitable remainder annuity trust or unit trust that's got 2 generations with a 25-year-old as the youngest? Probably not. What's going to happen is we're going to run afoul of the 10% charitable minimum rule. Remember back in 1997, Congress amended Code Section 664 to say that the time of contributions to remainder trust, whether initial or in the case of unit trust, subsequent contributions, the estimated value of the charitable interest at the time of funding had to be at least 10%. Okay, so the problem when you've got a 25-year-old and you've got a second generation, there ain't going to be a 10% charitable value, right? So right off the bat, I'm thinking, okay, gift annuity ain't going to work, remainder trust isn't going to work. We've got a defunct pooled income fund, but we're going to fund it with mineral interest. We're going to put a mineral interest gift into a pooled fund that's taking cash and taking marketable securities. So I'm thinking, okay, this isn't going to work. Then it dawns on me, because again, I'm on autopilot, right? I'm doing what all good gift planners have been trained to do, start to go through the options and narrow down, do we have an alternative? Then it dawned on me, well, what if this isn't a taxable estate? So I asked him, this is the very first phone call. And those of you who have known me a long time probably won't be surprised by this. So I said to him, normally I wouldn't ask this on the first phone call, but, would you be comfortable sharing with me do you think that your estate, you and your wife, are we talking more than $10 million? And he said, oh, no, we're way, way below that. And I said, okay. I said, how important is the income tax charitable deduction to you on the front end? So if something were created and funded, is that a priority for you, that you get an income tax deduction? He said, no. What he really wanted, he wanted to continue to benefit from the mineral interests for he and his family, and he wanted to be able to continue to manage those mineral interests until he got sick of it. And mineral interests do get to be a hassle over time, they really do. We have a lot of older people who just get overwhelmed with all the realities of trying to do new leases and the accounting, are you getting your money and all of that. So he said, no, that is very important. Income for life for these people, and I want to be involved in the management until I can't do it any longer. And I said to him, you might want to look at doing a trust that would qualify under California law that won't give you an upfront income tax deduction, won't give you an estate tax charitable deduction, but will still accomplish what you want. Because the question I had to myself was, well, if he doesn't need the estate tax charitable deduction, which he doesn't really need the gift tax charitable deduction, why am I limiting my thinking to just gift annuities, remainder trusts, and pooled income funds? And so I said to him, I think you could do a trust. We need to find a really qualified California attorney who's very knowledgeable about the trust law in California, and also would be helpful if they had some charitable knowledge also. And I said, and of course he had no idea who that might be. So I said, well, let me make some calls. So Robin, of course, who did I call? The Sonoma County Community Foundation. I called and I said, hi there, who I was, and can you give me some suggestions on some attorneys that have been involved with you guys that are knowledgeable about both estate planning. I was hoping they'd be board certified in California for estate planning, and also knowledgeable in charitable giving. So I talked to somebody in gift planning, and it was so funny. She said, oh yeah, we have our our list of people that we send out when there's a request. I said, how long is that list? Well, it's like every living attorney in that county. And I said, okay. And so she said, I'll go ahead and send that to you. So she did. So I called back, and I got somebody else, and I said, okay, I got the list that you guys give. So here's my question. Who of these people have served on your board? And then I got the short list, right? Who served on your board? And then I verified who was board certified in California for estate planning. And I went ahead and put a short, I think I had 4 or 5 names, and I made a call. I called the man who had been the board chair of that community foundation, was a former board chair, was certified in estate planning in California. I called him and talked with him. I said, here's my situation. I've got a donor in California or somebody who's interested, but I don't think this is the normal in-the-box kind of charitable planning. I think this is let's look at a trust, a non-qualified arrangement that can accomplish for him what he wants to accomplish for him and for us. And what do you think about that? And we talked about it, and he went, oh, this could be lots of fun. I went, that's what I thought too. And so I said, and by the way, I've got these other names. What do you think of these other people on this list? And he told me, he said, oh yeah, and he gave me, we kind of refined it down a little bit more. So I think I ended up sharing 3 names with the man in California. And I said, okay, I've had this conversation. I would be happy to talk with whomever you select before you go have the conversation. Because can you imagine a donor going in and saying, I understand this may not work, so here's kind of what we're thinking about. And he said, oh, okay. So he doesn't pick the guy I have the phone call with, but he does pick somebody on the list. And so again, I tried to call, and they were busy, and so I sent a lengthy email to that attorney saying, I just wanted to let you know what the situation is from our perspective, what kind of brought this about, and it just seems to me like maybe we need to do maybe a non-traditional approach here, because this other stuff isn't going to work anyway. And I will tell you, I think for the vast majority of people that we work with, we may find that the gift annuity, the remainder trust, the pooled fund, all the other stuff that we've been using isn't really the best solution for them. So I've had to continue to remind myself, Laura, don't default immediately to the qualified arrangements, because that may not be the best thing for the donor. Now the challenge for us, of course, is it the best thing for us? Because when I start talking about a trust under California law, does that trust necessarily have to be irrevocable? No, it can be revocable because he doesn't need estate tax deductions. So now we've moved from something where I might have been encouraging him to cut out some of the beneficiaries maybe, but I might be encouraging him to do something that's irrevocable. That he's going to move those assets, it's irrevocable, we can count that, we can put that in our records, we know something is coming. Now, who knows how much, especially in the world of gift annuities today. So I think for many of us, we're in an era, or increasingly going to be in an era, where we're really going to be tested. Do we really mean it when we say that we're here to help donors do what's best for donors? Now, certainly if you're on the professional advisor side of this equation, that's not a problem, right? That's what you guys and ladies live to do, is to do what's best for your clients. What about those of us working in charitable organizations? Now, what's best for the donor may be a little squishy for us. Would you guys agree with that? So how do we explain to the people to whom we report, why is it that we would have been involved in a discussion with somebody about maybe a better way for them that will ultimately still benefit us, but it's squishy enough that I'm just going to have to put it in as a revocable arrangement. I can put it in our world, we can put in an estimated value, but I'm moving from locked down, irrevocable, to not locked down. I'm moving from revocable. Yes?
How do you value a gift that's going to come in at 65 years on a mineral rights when the minerals may be gone?
Yeah. Get ready for that question. How do you evaluate something that might be 65 years? So I'm going to tell you the rest of the story in just a second. How do you value something that could be 65 years? And oh, by the way, it's mineral interest. And so we're not going to sell them, it's the production. Now, depending on where those mineral interests are, our mineral interest experts tell us that in some areas, 50 years, you can be pretty certain that there's still going to be some production. 65 is pushing it. So again, it's revocable, who knows what we'll actually get. Now, interesting, so this is more than a year ago I had this conversation with this man. And when I tell him, if he decides to do that, and then we put a clause in the trust that at some point in the future, if he resigns as trustee of that trust, or as special trustee to manage the mineral interest, then we'll step in. Then the University Lands Office from the University of Texas would step in, and we talk about what that would cost. So I talked to our experts, and we've got some of the best in the country who know how to make money out of mineral interest, and we talk about what would that fee be for them to manage those interests. Well, of course, now we're talking 65 years. They're going, 65. They're not as worried about the value. They're worried about oh my God, how do we figure out what we're going to charge? So I give them a range of what they say it would cost for them to manage those, and they do a few of those. I get back with him, and he just decides too much complication. I'm not going to do it right now. So they do something else. So just last week, while I'm traveling, I get an email from him. Hi, this is Bruce. And we went ahead and did this last year, and we decided to do this instead. And after a year, we're really not very happy with it. So now he comes back to me saying, life for he and wife, and then only a couple years for the youngest daughter. Aha, right? It's like okie dokie. I bet you the University Lands Office would be much more amenable to that. Now, I'm still probably going to talk to him about a non-traditional trust. Again, still, I don't think a gift annuity funded with mineral interest, even a remainder trust funded with mineral interest, doesn't make a lot of sense to me from the accounting perspective. So I've literally, guys, had to train myself now when somebody calls and wants to talk about a life income arrangement to stop. And instead of going immediately to what I was trained to think about, ask questions like the following. How important is an income tax charitable deduction to you on the front end? Now, what Robin just shared with us, Robin, right, we already know only about 30% of Americans itemize deductions. So now if we're going to go to a 2% floor for charitable giving, and that's 60% of the people who itemize, is that what you just said?
60% of the charitable dollars.
Of the charitable dollars, okay. So, just think, if that goes into the law, how many fewer people will actually be itemizing their charitable deductions? Plus, we've got that high income earner haircut that came back in the law a couple years ago. So if your income is high enough, you begin to lose itemized deductions. So I think increasingly for Americans, the question of how much tax savings you get on the front end from income tax deductions is going to be smaller and smaller and smaller. So next week, I'm going to visit with a doctor who's actually a physics graduate of ours and then went into the practice of dermatology. And about 3 or 4 years ago, and Hallie may remember this, You remember the man who did $200,000 of deferred payment charitable gift annuities? He did 8 of them, $25,000 each, and we did them as the flexible deferred so they could elect when the payments start. So the same week that the guy from California emails me, this guy emails me and says, we want to talk about another gift. I'm thinking a flip unit trust, maybe another deferred payment gift annuity. Now when I go visit with him next week at his house, I'm going to say to him, I'm going to ask him 2 questions. Number 1, how important is the upfront income tax deduction to what you want to accomplish? And number 2, do you have a taxable federal estate? See, the reality now of having $5.34 million that's increased for inflation means that we're not going to have Americans who just in normal growth or appreciation of assets are going to end up with taxable estates, unless the law changes, right? But for what we know right now, and with as locked down as Congress seems to be, you know, I'm wondering if they're ever going to pass any legislation, to be honest. But for what we know right now, for the typical person, unless you have very unusual assets, probably the market appreciation, the growth, is probably going to keep up with the index, the inflation index on the amount that you can pass a state tax-free at death. So I'm going to ask him those questions. How important is the income tax deduction? My guess is he's going to tell me it's not. And then, do you have a taxable federal estate? I don't think they do. So I'm going to say to him, okay, I know you want to talk about flip unit trusts and you want to talk about deferred payment gift annuities, but you know what? I'm not sure those are the best. I'm not sure they're going to help you do what you want to do because they're relatively young. So when I run the numbers on the deferred payment gift annuity, you know, the rates have dropped since he did the old ones. It's not going to look very good, and it's going to be irrevocable. He's going to lock into that. So I'm going to talk to him about maybe you want to talk with your advisors about doing a revocable trust that has charitable provisions in it, where you can continue to be the trustee, or you can hire other people to do that. It can have language that says at the end, anything that's left comes to us, right? Just like the gift annuity would have done, or the remainder trust would have done. You can still do that, but it's revocable. You've got all the flexibility. You can reposition it. You can decide down the road if maybe it's still not what you want, or maybe you need that money. I think that's the appropriate discussion for me to have with this doctor, not the sure, I'll sign you up for another deferred payment gift annuity. So in my 30 plus years now of doing this work, we've moved from a time where in order for me to feel competent in what I was doing, I really needed to know the federal law, right? Because the federal law of tax deductions, or the law of tax deductions, is really the federal law, and then the states just piggyback on that. So in Michigan, do you have an itemized charitable deduction, Robin? No. You used to have some credits, right, for some gifts to charity. I bet those are long gone. Yeah, they're real small. Okay. So, you know, across the country, some states have itemized charitable deduction. Now, ladies and gentlemen, I think we're at the point where you better either know the law or have access to people who know the law for the states in which your donors or clients live. So those of you who are here from charitable organizations, I know the University of Michigan is here, you've got people all across the country and internationally, don't you? Who else has people from, let's say, more than 10 states? Anybody else? Well, if you're in that position where you're literally working with donors or clients all across the country, the game has changed. Would you agree with that? Now, if we're going to have conversations with people about doing non-qualified charity giving, doing trusts that are approved under state law, we've got questions like, how long can they last? Do we get perpetuity? Who can be a trustee? How are they taxed? Now, a lot of the tax law is delivered at the federal level. We did the complex trust, we did a simple trust, some of that. But you need to understand, or again, have access to information about what are the parameters, because trust law is local law. Trust law is at the state level. Now, there are some federal